Hi, my name is David Howe. Today I want to talk to you about credit and credit scores. I hope you'll invest some time to view this presentation because I'm going to share information I've learned over the past 27 years that you can use to improve your credit and scores. I recently obtained a perfect 850 FICO score. It's a pursuit I've been working on for more than 10 years. I also obtained a perfect Vantage score. The Vantage score is a competing model created by the three national repositories, Equifax, Experian, and TransUnion. Its purpose is to gain market share and compete against FICO. FICO stands for Fair Isaac Corporation. You probably already know that. It's the company that invented the credit score. And it's a company that you should know more about because its technology impacts your life in many meaningful ways today. So let's talk about credit and credit scores, including the FICO score. I'll explain in detail how I obtained a perfect 850 FICO score and a perfect 990 Vantage score. We'll look at lender-based scores versus consumer-based scores. I'll show you how a lender-based FICO 850 score appears on a federally compliant risk-based pricing notice. We'll confirm that scores are highly correlated relative to their rankings with other scores, at least among high percentile scores. I'll demonstrate how consistent credit bureau data yields consistent rankings across multiple proprietary scores, including educational scores that consumers access regularly. Obtaining a perfect score should not be an obsession. It's not realistic and it's not even possible for a broad section of consumers. But maximizing one's score should be a pursuit. Knowing what factors impact your individual credit score should be an endeavor for every consumer today. If you are a consumer struggling with difficult financial circumstances, hang in there. Things can and do get better, including your credit scores. Dave Ramsey describes the FICO score as an I love debt score. That's an inaccurate description. Debt-to-credit ratio is not the most important factor in a credit score. It's important, but payment history is even more important according to FICO. So it would be more accurate to call the FICO score a behavior score or a payment score. But it's really a risk rank order technology. Its design is to predict whether a consumer will pay as agreed. And it does this through scorecard technology that measures granular predictive factors. The factors include payment history, outstanding debt, length of credit history, types of credit, and the pursuit of new credit. We'll look at each of these factors as it relates to a perfect credit score. By the way, there is no conspiracy behind FICO or other credit scores. And remember, FICO does not own the predictive factors. Neither does Equifax, Experian, TransUnion, or SubscriberWise for that matter. Credit scores are designed to be predictive because we have a voluntary credit system in America. That means that creditors will buy that information. They will buy those credit scores to help them in their underwriting, to help them with their business processes. So there's actually a motivation for companies like FICO and TransUnion and others to make these models highly precise. If they were not precise, if these scores did not accurately predict future performance behavior, companies would not make the investment. It's important to remember that credit scores are dynamic, and that means that the information is updated frequently from the credit bureau, and so when the score is generated, when a credit submission is processed in a lender-based system, information could have changed from 1 hour to the next or from one day to the next, and that's why credit scores change. Consumer Reports recently published an article that indicates that these credit scores are not correlated, or they're not consistent, or that they vary widely. I'm suspicious of that claim, and I would like to see some evidence of that, rather than just having an anecdotal instance where an individual obtained an educational score and decided that his scores were better than they were, versus the time that the bank or the lending institution obtained its lender-based scores and charged maybe a different, higher interest rate, we need to have evidence if that credit report is consistent for those circumstances. In other words, has the data on the consumer report changed? Is the credit report that generated one score different from the data that generated a lender-based score, for example? One of the things that I want to demonstrate with my credit, looking at credit data that is highly consistent, where there is the same balances owed on the same types of accounts with the same mix of credit, we'll see how consistent these scores really are, even when comparing a lender score with a educational score and looking at proprietary scores from different companies. Now, most people understand how credit scores work, but they don't always understand how a credit score is generated. About 18% of the population does not generate a FICO score. In order for a FICO score to be calculated on a credit report, the report must contain enough information and enough recent information on which to base the score. Generally speaking, that means that the individual must have at least one account that has been open for 6 months or longer, and at least one account that has been updated by a creditor to the credit reporting agency within the last 6 months. So it is important that consumers actively use credit so that they can continue to generate a score. So among the 18% of consumers who do not generate a credit score, they have a file at the National Repository. There just has not been any recent activity or any updates to that credit bureau report. Now, there are 5 primary areas that make up a credit score. These areas are relatively consistent across different models, and that's because these items indicated are the items that are predictive. Of course, it's also true that a credit score is based only on the information that's contained on the credit report. So things like age, race, national origin, sources of income, etc. are excluded. So if we're looking at this grid that FICO has provided, we can see that payment history is the #1 factor. That's given the most weight. We look at amounts owed, that's the credit to debt ratio. The length of credit history is 15%, and new credit and types of credit in use equal 10%. Now, it's important to understand that there are 12 scorecards in the latest version of FICO, the FICO 8 score. There are 8 non-derogatory scorecards, and then there are 4 scorecards for consumers who have derogatory information. Now, it's of course proprietary how the various factors are implemented or used within each of those scorecards. But scorecards are one of the reasons that credit scores become predictive, because they look at these granular factors within each scorecard. A consumer gets segmented based on information on their consumer report into similar credit scorecards, and then these various factors are calculated. A FICO score takes into consideration all of the categories of information. It is not limited to only 1 or 2 or a handful. It's all 5 of those factors. So in other words, no one piece of information or one factor alone will determine the calculation of a FICO score or any credit score. Moreover, the importance of the factor depends on the information that's in the credit report at the time the credit information is submitted. For some people, a factor may be more important than for someone else with a different kind of credit history or with a different scorecard. So what factors have to be present to generate a perfect 850 credit score or a perfect Vantage score? I have a copy of my credit report from Experian, and this particular credit report generated an 849, and we'll take a look at that. But looking at these first few factors, you can see I have no missed payments, and that makes sense. If you're going to reach the maximum points on a credit in a credit scorecard, you could not expect to have missed payments, because payment history, of course, is the most important factor, 35% according to FICO of the calculation of a credit score. It's also indicating that I've limited the use of available credit. Ratio of revolving balances to your credit limits, 4%. And we're going to talk about why you must have a revolving account balance on a consumer credit report when a credit score is generated to maximize your points. Now also, if you look at number 3, my established credit history, my credit history is 27 and a half years old. This is a key factor. In order to get segmented into a scorecard that has the maximum 850 range, a consumer must have an established credit file. Now, what that age is, that's FICO's proprietary information. My guess is it's going to be 15 or more years, probably 20 to 30 years of credit history. That's going to be indicated in order to generate a scorecard that has the maximum 850 range. In other words, if you're 20 years old and you've only been using credit for 2 years, you're new to credit, you just moved out of the home and you've been applying for a few accounts and you have 2 years of credit history, it is impossible, even if everything else on that credit bureau report is precise and perfect, you cannot achieve an 850 because the scorecard that you are selected into will not have that maximum score range. Now number 4 says you've been responsibly limiting the number of credit accounts that carry a balance. This is true for me and for my specific profile, and I think it's going to be true for most consumers. In order to maximize the credit score, in order for me to obtain a perfect credit score, and remember I've been monitoring this information for more than a decade, it required 1 installment loan and it required 1 revolving account with a limited balance, with a low balance, where the utilization was under 5%. And with the installment loan, which in this case was a mortgage, the credit to debt ratio was 45 to 55%. So I could not obtain a perfect credit score without having 1 credit card, 1 revolving balance that reflected a balance due, and also having an installment loan that effectively has a balance that's 50% paid. Now we haven't really talked about the new credit or what would be considered inquiries or the types of credit, but I have a credit at a glance that was contained on my FICO report that you can see. It's indicating that my revolving or open-ended accounts is $2,785 and the mortgage is $26,000. It's the combination of those 2 accounts that generated a perfect credit score, in addition to 27 years of credit history, no adverse information, and no inquiries on the consumer report. And by the way, here's the FICO score that generated an 849 with Experian. With TransUnion, it was an 850. So there is 1 point that I'm missing, and it looks like it has to do with the amount of new credit. My assumption is that in June, when my mortgage has been booked for the full 12 months, that will generate that additional 1 point. Next, I'd like to show you a summary of my credit accounts. This question has come up before. The question is, how many credit cards do I have, how many mortgages, etc., and what are the balances? So again, this is the information that generated the perfect 850 credit score. And in fact, this data will generate a credit standing, a credit percentile in the 99th to 100 percentile in any model that I've looked at. And we'll take a closer look at that so you can see again that information is highly correlated when the data is consistent. The consistent data yields consistent rankings. Not necessarily the same score. The absolute score can be different because score ranges are different, but the relative ranking compared to other consumers, that's a metric that we should consider. So you can see I have real estate accounts. We have Experian, Equifax, and TransUnion. I have 2 accounts, 2 with balances, and it's all the same. Interestingly, you'll notice with my revolving accounts, I have a total of 11 at Experian, 8 with Equifax, and 7 at TransUnion. And that's because there were 1 or 2 credit accounts that did not report with all the bureaus. So you can see Experian had the most revolving data reported. TransUnion had the least. Now, the interesting thing I want you to note here is that my balance with Experian in this instance, when this was obtained, was $0. This is why it's difficult to game a credit score, and you really can't game a credit score because, as I said earlier, the predictive factors are what they are. In other words, if you have a 30-year mortgage and you've paid that mortgage for 25 years and you started with a $100,000 balance and today you owe $8,000, that in and of itself is a very strong positive factor on a consumer report because you have demonstrated that you're a stakeholder in that property, you've paid it down substantially. That's a predictive factor. But regarding this zero balance, this was reported before my statement cut, so you don't know exactly when a balance is going to get updated. The point is that when a credit score is generated against this data, the Experian will have a loss of points because I have no revolving balances indicated. I'm going to prove that for you by looking at some additional credit reports that I generated within days. And again, this is the kind of information that I expect consumer reports to demonstrate. When they talk about how scores may be inconsistent, we need to see, is the data consistent when the scores are generated? I can produce that kind of information to prove that, at least in my instance, the scores are highly consistent. So for my installment accounts, we have 7, 9, 6. These would be various car loans that I've had over the years. I have at least a couple of student loans that are reported. They're all paid, as you can see, with zero balances, but those accounts are maintained on the credit report. Positive information can be maintained forever. Some of the repositories will remove it after a decade or more if there's no activity, if the account is closed. I have no collection accounts, and this is a summary that includes my total accounts. You can see it's 20, 19, and 16. Here are the balances. The balance could be slightly different based on some escrow, whether my escrow payment information is reported. You can see I have a total of open accounts. I have 6, 7, and 6. And closed accounts, I have 14, 12, and 10 with the competing repositories. Notice too the inquiries are indicated. I have 2, 3, and 1. 3 is contained at Equifax. And I'm going to talk to you about the impact of these inquiries here in just a moment. Now let's continue with this report from Experian. It's a triple alert service that I purchase that monitors my credit and gives me access to these educational scores. It's very likely that the scores here are not used by lenders. This is not a lender-based score. But what I want you to see here, there's a few things that I'm going to mention here. Notice the score. It's a 793 on a scale of 330 to 830. So it's not a perfect score, but my guess is that this score, this model, will never generate a maximum 830 score. There are credit scores, even FICO has a few older models, where the range is set beneath the 850 for FICO, or in this case the 830 for Experian. I can't say that unequivocally. I can with FICO. I have a supporting document to prove that. But my guess is, by looking at my score, and what I want you to notice is that my ranking, which is 98.9% higher than other U.S. consumers, it's unlikely that there would be an additional 37 points that I could obtain. But we're talking about a very small percentage of individuals that would have that additional 37 points. But remember, my Experian credit report, when this was generated, showed 0 revolving balances, and my score is a 793. If we scroll down and look at the 2 additional scores, we're going to find out that I actually have a 797 at Equifax. Because I had the revolving balance, I gained 4 points, 4 net points on this specific model. But notice the credit ranking. Your credit ranks higher than 99.52% of U.S. consumers. So data is consistent. We see a consistent ranking relative to the score. The score itself Surely that's not going to be the same thing as an 840 or an 850 on a FICO scale, but it is a different model. What we're looking at, however, is that there is consistency among the relative ranking with other consumers. Let's look at the TransUnion credit score. And notice it's exactly the same as the Equifax. And the ranking, 99.52%. So we have three different, it's one model, but it's applied to three different credit reports, and it basically yields exactly the same information. This is very contrary to the information that Consumer Reports is putting out. And again, I'm going to hold them to a higher standard of journalism. I want to see evidence of these discrepancies when the data is the same. I want to see that these scores are not consistent. This is a screenshot that I obtained from Credit Karma. I have an account with Credit Karma, and you'll notice there's the 990 Vantage score. That's a perfect Vantage score. The model goes up to a 990, and my ranking is 100% higher than all Credit Karma members. So this is, not necessarily reflective of the general population. I'm not sure, from a demographic standpoint, who is using Credit Karma, but at least we can realistically assume that the score reflects an accurate relative ranking by demonstrating 100% higher performance than the rest of the members. I want to conclude with a few more examples of information and some comparisons that I think you'll find informative. The first thing I want to do is show you the 850 on a risk-based pricing notice. This is a notice that is federally compliant with the Consumer Financial Protection Bureau, and it's consistent with the law, where the law says if a creditor uses a score and charges a deposit, for example, for telephone or cable service, that a consumer should and must have access to the credit score, the source of the score, and the date the score was obtained. So this is an actual lender-based FICO 850. What I want you to notice too, though, is that there are no scoring factors with this 850. And that's expected, because if the consumer reaches the maximum number of points in every category, there would be no factor that would be assigned that the consumer could learn or understand that would improve the score. This is the maximum possible score. Let's look at two other examples, and I'll clarify what I'm describing here. Here you'll notice I had an 848 that was generated on August 29th. At the time, I had more than one credit card with a balance. My mortgage was probably still outside of the right threshold to generate the maximum number of points, and I had too many inquiries. And by the way, too many was one too many. The other interesting thing that's noteworthy here is you'll see there are actually three factors, and the factors are listed by importance. So too many accounts with balances is the single most important factor. But what's interesting is there are three factors, and yet I had an 848 on this date when the credit was scored. So although I was only 2 points short of a perfect score, I had three factors. So what we can conclude, or what we can know from this, is that every factor is not necessarily equal to 1 point. And of course, some factors can be many, many points. A factor like serious delinquency or a charge-off would mean many, many, many points. But the impact of a single inquiry in this case is extremely minimal. It has to be less than a single full point, again indicated by three factors with the 2 point loss. What I want you to notice here is on 11/17/2013, my score dropped to a 791. And what happened is I maxed out my credit card. I maxed out a revolving credit card. I had a $10,000 line of credit, or $10,000 credit availability, and I took all of that, every bit of it. So that fact of maxing a credit account against a score that was in the 840s basically was a 50-point hit. And you can see that the number one factor in this instance is the proportion of balances to credit limits is too high on bank revolving or other revolving accounts. Now, this is one of the reasons, though, that I argue that a consumer should maximize their credit score. So, in other words, every consumer should pursue the standard of excellence. And if the standard of excellence is an 850, make that your goal. It's certainly not wise to obsess over that. And obviously, there are a lot of life events. But I am frustrated when all of the self-proclaimed experts sell everyone short. The reality is that by having a maximum score, in my case by having a score in the upper 800s, I can still max out a credit card. And if I needed to go get a mortgage, I would still qualify for the most favorable terms because I had that large buffer. Now, another thing to consider is I am a statutory agent for SubscriberWise. I am the majority shareholder of the company. And what that means is that if I have to do $1 million integration with another company and I have to get a line of credit or a cash manager account, the bank is going to do a credit check on me. I will be considered a personal guarantor. And this has happened many times. If I've opened a cell phone account, I've opened a line of credit, I have a business Visa account. All of those instances require credit checks on me individually. And that means that those are going to be hard inquiries, and those could potentially lower the credit score. So maximizing your credit is key. And that's why I don't want individuals to look at their credit as just a passing interest. You should know all of the granular details. Consumer Reports says it's a waste of money to buy credit scores. Their advice is bad. I have spent money buying credit scores. Now, I do agree that the information should be provided. We should have access to our credit scores. But in the meantime, until that happens, I will make these investments, and it has paid off for me. I have obtained 2 perfect credit scores, and as you can see, my credit is in a very, very good standing, because I recognize that if credit is going to control so much of my financial life, then I am going to understand it and I'm going to control it rather than it control me. And by the way, what I'm showing you here is a Vantage score. This is a genuine Vantage score that I purchased from Experian on April 24th. And what I want you to see is the score is an 830. The maximum score for the Vantage score, this particular Vantage model, is 850. So I don't have a perfect Vantage score in this instance, but what you can see here again is the relative ranking. Your credit score ranks higher than 99% of consumers. So again, we've looked at Experian Plus score, we've looked at Credit Karma, we have looked at Experian Vantage score. Every one of these scores yields the same very high ranking because the data is consistent across all of my credit bureau reports. And when these scores are generated, the data is the same. And that's the problem, is that consumers don't recognize how fluid a credit report is. The data can change literally hour by hour. And if there is a change, for example, if I have a credit account or a credit bureau report that has 3 credit balances from revolving accounts that gets updated and my scores run, I will lose 20 or 30 points. And it might look like that these scores are all wild, that they're not consistent, but it probably has more to do with the data changing on that consumer credit report. You know, there are thousands of data furnishers, and you have banks and mortgage accounts, and you have personal finance accounts and car loans and student loans. So the potential for that credit report to get updated is very, very high. And statements cut at different periods. Information gets reported differently. There's just so many potential variables. So if we're going to make a claim that scores are not correlated or they're not consistent, we need to make sure that we actually have the evidence on that credit report to demonstrate, was the data consistent when the score was generated? If the scores were not consistent, is there another explanation? And one more thing that I forgot to mention regarding my revolving accounts. One of the reasons I have obtained this perfect credit score, these perfect scores, is I have not opened a credit card, a revolving credit card account in 10 years. That is a component of a scorecard that has the maximum potential range of 850. In other words, if you have recent opened revolving accounts, it's very unlikely that you would get segmented into a scorecard that had the maximum 850. And people ask me, well, I have no blemishes on my credit. Why is my score not higher? That is one of the explanations. Maybe their credit is clean, there's no adverse information, no derogatory information, but maybe they have too many recent opened accounts. So there's so many multidimensional variables. There's no way that I could truly offer an exact explanation. But again, from my perspective, from my unique credit circumstance, having a credit card that's at least 10 years old has been a very positive factor, in addition to having low utilization, a long and established credit file, and a mortgage, and those other positive factors. I'll conclude with just a few more examples. These are pretty profound examples. We're going to look at the impact of credit inquiries, and then we'll take a closer look at the consequence of not using your revolving credit card, or at least not leaving a small balance on your credit report when a credit score is going to be generated. What I want you to notice here is that on March 31st, my FICO credit score at Experian was 846. This particular credit report had one inquiry that was going to fall off on April 1st. So what I wanted to do was calculate what was going to be the impact of one inquiry between March 31st and April 2nd, when I knew that inquiry would come off. So you can see here's the credit summary, $2,700 in revolving, $26,000 in mortgages. I have one recent inquiry on this credit report, 846 FICO. Now you'll see that my score on April 2nd is an 849. So it is a net gain of 3 points. Let's go back and look at the same credit summary information. So here it is again. You can see the revolving balance, the mortgage, exactly the same. But notice the recent inquiries is a 0. So that is the only change that exists on the credit report. And by having an inquiry that is no longer calculated, I gain 3 points. Now, regarding inquiries, according to FICO, inquiries have a small impact. For most people, one additional inquiry will take less than 5 points off their FICO score, and I have seen evidence of that. It's also true, though, that inquiries can have a greater impact if you have few accounts or your credit history is not well established. Large numbers of inquiries mean greater risk. That's a predictive factor, and again, I stress that FICO identifies those factors, but they do not own that factor, meaning if somebody has 20 credit inquiries in a 2-year period, there is empirically derived evidence that makes the consumer a higher risk. And it's the job of FICO and the other analysts to identify those predictive variables and to factor them into their credit score. So, for example, if a consumer has 6 inquiries or more on a credit report during a 2-year period, they can be up to 8 times more likely to declare bankruptcy. And again, that's empirically derived information. It's not that somebody's making that up. Now remember, the government says that we as consumers have a right to know every step of the way who's looking at a credit report. So that's one of the reasons why inquiries are coded. There's hard or voluntary inquiries, and there are soft or involuntary inquiries. And as you know, soft inquiries, for example, if you go for an auto insurance rates, or you apply for a job, or you check your own credit, those are all soft inquiries. They do not impact the calculation of a credit score. Other creditors do not see them. But they are maintained on your credit report because it's evidence that someone or some organization accessed your report. So that's one of the benefits of checking your credit reports thoroughly. You want to make sure that you can see who's accessing the credit report. Now, there are permissible purpose use of consumer reports. You don't have to authorize every instance. There could be a marketing offer, for example, that's based on criteria set by a creditor, and they could generate a permissible purpose use of your consumer report for marketing purposes. So just understand that there are two kinds of inquiries. There are hard and soft, and the calculation of the inquiry may or may not impact a credit score. And just really to clarify that point further, even a FICO scientist, an analyst who created the technology, could not tell us the impact of a single inquiry. They could offer an educated guess, but keep in mind this is an algorithm, and it considers the entire credit report. Some consumers have what's called a thick credit file. Let's say that you're 50 years old and your credit file contains 15 mortgages and 20 credit card accounts, and you've had 4 other inquiries, and you have one 30-day late and one 60-day late. One item is aged 6 years. One of the delinquencies is more recent. You see, so when you look at all of those various factors to say what is the impact of another inquiry or of a single inquiry against that entire credit report, there's no way that we could say with accuracy. That's what makes it an algorithm. It looks at that scorecard, it applies these various factors, it looks at the relationship of these factors, and that's how the score is generated. So look at what happens to my credit score on April 3rd. I have an 824. I have lost 25 points, and I'll explain why. I lost 25 points because I had no revolving balances when this credit score was generated. Let me show you. Notice at this credit at a glance summary, my mortgage is the same, $26,215, but my revolving balances are 0. So I have only one account with a balance, and I have lost 25 points. Now that seems counterintuitive, but remember, what is predictive, what is proven predictive, what generates the most scores, the highest score, are consumers who have demonstrated use of revolving credit accounts in addition to other credit accounts, what we call the mix of credit. So the most favorable scenario would be one revolving balance that has a small balance relative to the available credit or low utilization, and one installment loan or one mortgage that has a favorable credit to debt ratio, where probably at least 40 to 50% of that initial amount or initial credit line is paid. That's the most favorable situation. So I would still be considered a sub or a super prime borrower. My credit would still qualify me with an 820 to get the most favorable rates. But what you need to understand is that to maximize your credit score, and especially if you're going to be shopping for a car loan or a mortgage and your score is, say, a 730 or 740, and you have no credit card balances, you want to generate a credit card balance. That will boost your credit score, and only do it on one of the revolving accounts. That is what triggered the perfect credit score for me. Now I'll conclude by giving you some additional advice that I think is very important. Let's use an example that you're going to buy a new car, and it's a $20,000 vehicle, and you have a $5,000 down payment. So when you go to the lender, to your automobile dealership, and you finance that car, and let's assume that you have good credit, your credit's in the 600s and 700s and you're going to get approved, and that you also have a stable job and that you're going to meet the underwriting requirements to be approved for that car loan. What you would want to do is to, if you have the $5,000 down payment and the car is $20,000, you want to make a $500 down payment, so that you're actually going to finance $19,500. Now again, we're just using example numbers. Obviously there's going to be taxes and other costs. But for this example, you would finance $19,500. And then what happens is that's the information that gets booked on your credit report. The credit report will reflect that you've obtained, let's say, a 48-month automobile loan with a $19,500 outstanding balance. And when you get your first statement, when that first payment is due, take that $4,500, that additional money that you were going to use for the down payment, and pay that on the loan. What is the benefit of that? It's very simple. You now have created a more favorable credit to debt ratio, so that what the credit report shows is that you have an original balance of $19,500, but you just paid an additional $4,500. So now you only owe $15,000, and that is going to be a positive factor for your credit score. That will boost your credit score. And remember, you're not gaming the system. What that is saying from the standpoint of the credit report is that you are a demonstrated stakeholder in that vehicle. In other words, you had an original balance of $19,500 and now you owe $15,000, or let's say you paid 20% of that loan back. That is a positive factor. So it's not a way to game the system, it's a way to maximize your points. And never apologize for maximizing your points. As I said earlier, credit controls so many elements of our lives today. So given that reality, you have a responsibility to understand how these things work. I've heard it said before, if you can't beat them, join them. So in a system where credit is king, you need to understand how it works and how to maximize your position. And when you have the self-proclaimed credit experts selling you short and asking you to accept less than the standard of excellence, reject their advice. They're really doing that because they can only mimic the same things that we hear over and over. The reality is those self-proclaimed experts, they have not invested the time or the energy to learn credit in the same way that I have, and that's why they can't provide you with these specific details that will maximize your credit. I hope this information has been helpful for you. It's certainly been helpful for me as well in my pursuit. And just for the record, I am the president of SubscriberWise. We're the largest issuing consumer reporting agency for the telecommunications industry in America. I'm also the credit manager for MCTV, and I'm responsible for the bad debt and equipment losses on sales of more than $60 million. So my obsession with credit is based in part on my professional responsibilities. And that's one of the reasons why I make my best effort to learn this information and to excel. And I want the same thing for you.